Hey everyone, Jeff Dorman, Chief Investment Officer at ARCA, back for another edition of That's Our Two Satoshis Live, where we talk about the digital asset market, what's happening for the week, what's going on. Usually it mirrors what we write about on our website, ar.ca/blog. You can see the written version of That's Our Two Satoshis. Comes out every Monday, where we talk about what's going on. We've been doing it now for 6.5 years, probably one of the longest running, if not the longest running, digital asset market recaps. So obviously we wrote this on Monday. Lots changed since then, even though it's only Tuesday here. And as a reminder, quick disclaimer, nothing that we talk about here today is going to be investment advice. Do your own research. And obviously I'm alone today. Usually we have a guest. Shout out to those who are watching today who want to be a future guest. Reach out to us if you have a topic you want to talk about. But lots changed from Monday to Tuesday. Really, the last week and a half has been pretty bullish for risk assets in general. You saw equities kind of march back to all-time highs. The 10-year Treasury the yield has started to decline from recent wides after the FOMC meeting a week and a half ago. Crypto being mostly higher. You could attribute a lot of it to just overall sentiment in terms of why digital assets were going higher prior to yesterday, and we'll get into that in a second with the Ethereum ETF news. But really, there's probably two specific pieces of data that I thought mattered for the digital asset market. One being the Senate rebuking the SEC by overturning SAB 121. SAB 121, of course, being a proposal that would make custody for crypto impossible for banks, just being way too capital intensive, having to have basically double the amount of assets against liabilities in order to custody it. So the fact that that was overturned, and more importantly, that you had a lot of Democrats who had previously been in Gensler's corner and Warren's corner, basically going to the other side of the aisle and realizing that maybe being crypto unfriendly isn't really working all that well. And of course, you have Trump piling on as well, accepting crypto for his campaign, and also basically explicitly saying a few weeks ago that a vote for crypto is a vote for Trump. So I think the Democrats feeling a little bit of a heat, which has certainly led to a better sentiment from a regulatory standpoint in the digital asset market. And then also you had a slew of 13F filings coming in. These are the mandatory requirements for RAs and funds to state their holdings. And after the Bitcoin ETF came in January, after you had a full first quarter of the ETFs trading, you had a ton of filings coming out in the last couple of weeks talking about who actually owns this Bitcoin ETF. And quite frankly, it's just blowing away any other ETF launches ever. It's bigger and more diversified than anyone anticipated. IBIT alone, the BlackRock ETF, Bitcoin ETF, ended up with 414 reported holders, which is, even having 10 or 20 holders in the first quarter would be pretty good for most previously launched ETFs. So with BlackRock having 400, Fidelity's well over 200, the Bitwise ETF and the ARK ETF close to 100. I mean, these are just record numbers. So I think those two things alone certainly put a positive spin on the digital asset market. And then, of course, late yesterday, you had some news coming from the great reporters at Bloomberg who cover the ETFs, talking about what the expectations were for the Ethereum ETF. For those who don't know, there's a process here with regard to exactly the order in which these ETFs can be approved based on when the filings were. Similar to the Bitcoin ETF, there is a handful of companies that are ahead of others. So Van Eck being the first one here, the SEC final deadline for them is on May 23rd, which is 2 days from today. Then you have ARK on May 24th, and then the rest coming May 30th, June, July, August, etc. Basically, the SEC had to either deny upon this final deadline, or they have to approve. Almost nobody expected an approval, though the odds were very low. There was a few, shout out to Coinbase, who recently said the odds were a little higher than people thought. But even those that were bullish on an Ethereum ETF going through were still in the 20-30% probability range. And then late last night, the Bloomberg ETF specialist came out and said, we're updating our odds from 25% to 75%. Basically, there was just a complete about face, 180-degree pivot in Washington with regard to the Ethereum ETFs. And quite frankly, this is driven by the political pressure. Like I said, I don't think the Democrats in office really understood, or certainly they miscalculated just how many people really do care about crypto and digital assets, and how that was potentially going to be maybe a swing factor in the upcoming election. Again, with the SAB 121 being overturned, as well as Trump gaining momentum with some of his comments, this seems like it came out of left field because it did. It came from the top, political pressure saying we can no longer be anti-crypto. And it's interesting, right? Because if you think about it, intuitively makes sense. For all the super passionate people about crypto who really love it, um, it's a small cohort, but at least it's a cohort. But there's really very few people on the other side who passionately hate it, right? There's a few outspoken people, your clowns on Twitter who do everything just for effect, your Peter Schiffs and your Minoru Rubinis and things like that. But for the most part, there's very few people who outright hate crypto and actually, would ever vote somebody in because they're anti-crypto. So it's just a massive miscalculation in Washington, not understanding uh, how many people really do care about this. And if you have one pro crypto candidate and one anti crypto candidate, you know, the pro candidate's going to win a lot of votes. So this might be the first of many things that we see from now until the November elections that shows a little bit of that political pressure starting to seep down into the SEC and beyond. So, we'll see on Thursday if it actually does get approved. All signs are pointing to it being approved. And as a result, Ethereum shot up, 24%, I believe, over the course of 24 hours. Pretty big move, and there's a reason to that besides just the fact that the Bitcoin ETF was so successful and the Ethereum ETF is viewed to be, successful as well if and when launched. But it's also because Ethereum has been such a poor performer in the market relative to Bitcoin and relative to other layer ones like Solana and Near and Avalanche. A lot of long short funds and a lot of individual traders who trade with leverage have basically been long anything short Ethereum, right? If you want to increase your exposure, you need to have a short side on the other side. And almost everybody was using Ethereum for that. So you definitely had a little bit of a short covering rally as well. What's interesting is the ETH Bitcoin ratio is still near the lows, even month to date after this big Ethereum rally yesterday. Month to date, Ethereum and Ethereum and Bitcoin are still basically up the same amount. So really, this is just a big catch-up trade from how much Ethereum has been underperforming, more so than it is, really taking off. Month to date, Ethereum now up 21%, Bitcoin up 19%. And of course, year to date, they're now basically flat. Ethereum's up 58, Bitcoin's up 57. So again, really just sort of a reversal of a trend. Certainly not a massive outperformance. We'll see if it has any legs as we actually get closer. But one of the things that I was talking about in this week's two sats was kind of just random thoughts on where we've been, where we're headed. What are some easy, low-hanging fruit that the digital asset market can improve on as we head into what hopefully looks like a continued rally into the election, into this ETF launch, and into some big project launches and token launches. So number one, we've addressed this multiple times in the last few weeks. We have to get rid of these low float, high FDV launches. For those who don't know, this was basically a trend started by Sam Bankman-Fried, and I'm not really sure why something invented by a guy facing 25 years in prison has become the market norm. But you're seeing this all the time. You're seeing these projects that are just putting a tiny, tiny bit of their float onto the market, hoping that because there's low float, it'll get pushed up to higher levels. And then they ultimately inflate the asset further at higher prices and slam the market back down. This is why every listing on Binance and Coinbase has been getting crushed. This is why every venture capital investor is on their heels talking on Twitter, talking about why they're not the bad guys. Basically, this is something that just needs to stop. You just don't see it in traditional markets this way, where you just have a tiny, tiny, tiny piece of the float out there with massive unlocks and inflation schedules behind it. So, we've, like I said, the last couple of weeks, we've written about this. We've taken, a couple of shots at the market makers, the token founders, the venture guys who are investing in this stuff, as well as the exchanges like Coinbase and Binance. It's nice to see that this is starting to get momentum. Binance came out in a blog this week saying they're going to stop doing this. You've seen a couple of other prominent investors besides Arca jump on this. So nice to know that we were ahead of this. Nice to know that others are piling on, and then hopefully that just goes away. Separately, one that we've talked about as well, another thing that we just need to stop to improve the overall health of the market is these pipes. For those who are not familiar, PIPE stands for public in private equity. It's when a company has a publicly listed stock, but then they do a private deal at a discount anyway. It's a very, very unused practice, quite frankly, because it doesn't work very well. It's really an act of desperation in the equity market when you do it. It's because you just don't have an investor base, or you don't have a good enough float on your stock, and you have no ability to sell stock to the public market, even though you're a publicly traded company. It's usually zombie companies or reverse mergers that never got any traction. You just don't see it in the equity market. Like I said, it's a complete act of desperation when you do it. Yet this is the norm in tokens. We see, I guess we'll call them PIPs, PIPT, private in public tokens. You have tokens that trade publicly. They have volume on exchanges. They have volume on dexes. And yet these founders are somehow have been convinced by the venture community to continue to do these private rounds at discounts, unnecessary sales. If you need to grow, you can certainly just use a market maker and put more tokens out there to the public. You don't have to do a big sale and worry about the SEC. You just leak it out there slowly with market makers in a transparent way. We get rid of these pipes, and it'll cause a lot of these problems to go away with these massive supply overhangs and unlocks. It'll also make money stop flowing into just venture funds and actually start flowing into more liquid funds, which is necessary as well. These venture funds have gotten too big for the market, and then as they grow, they have nowhere to offload the tokens because there's no money coming into liquid, because these venture guys continue to get these gift wrapped discounted deals that make no sense in any other market. The third one that I think we could work on to improve, and each of these that I'm mentioning here, I think could probably be its own blog post. Maybe we'll break them down further over time. But the third one here is governance. To me, there's a real easy fix. Anyone who's been involved in an on-chain governance vote, especially with a DAO, they've been real clunky. They don't work. They don't get high participation. One real easy kind of low-hanging fruit change we could make is to just add a regular cadence to voting. Take the presidential election coming up, right? Everybody knows it is the one day every 4 years where you vote on the presidential election. It's not, any time over 6 months it could happen, and I hope you're near a voting booth when it happens. It's no, we know ahead of time what is the day. Okay, so how do you replicate that in on-chain voting? It's very easy. You say, okay, any proposals that want to go up for a vote have to be in by the second Tuesday of every month. And then voting on any outstanding proposals will always occur once per month on the 23rd, or every other month on the 23rd. You set a cadence where you let people know ahead of time when voting will take place, and it'll improve the proposals. It'll improve the voting mechanism. It'll improve participation. This idea of just surprise votes whenever you feel like it are never going to work. So again, there's other issues with governance and voting. This is a real low-hanging fruit that we can solve for. Lastly, as it pertains to the ETFs here with Ethereum and Bitcoin, I've had the luxury of, over the last 7 years running ARCA, of meeting with thousands of pensions and endowments and high net worth investors and family offices around the world. And, I have 75-year-old parents. I don't say anything about digital assets unless I can convince my parents that it makes sense. Because, we're largely dealing with investors who don't know that much about this space, and you have to come up with what resonates. So I've tried a lot of things that don't work, and I've tried a lot of things that do work. And when you have something that works, you should use it over and over again. So this one is a shout out to BlackRock and Van Eck and Fidelity and Bitwise and ARK and all those that are about to be launching the Ethereum ETF. Do not call it ultrasound money. Nobody gets it. Nobody cares. Do not call it an internet bond. Nobody gets it. Nobody cares. Do not call it a supercomputer. Nobody gets it. Nobody cares. Trust me, I've tried them all. They don't care. The only thing that has worked is describing Ethereum and other blockchains as an app store. You say, when you build a layer one blockchain, it's a blank canvas. It's a blank app store, no different than the Apple App Store. But over time, people start building apps inside of it. You have your Bank of America and your Citigroup app in your iPhone. Well, you have your Uniswap and your Aave app on your Ethereum app store, right? You have your DraftKings app in your phone. You have your Rollbit app on your in your Ethereum app store. You have your gaming apps, right? Your Angry Birds or other games on your phone. You have your Axie Infinity or your Illuvium in your blockchain app store. And you go down the list, right? This actually starts to make sense. And then what does it mean? Okay, well, if Ethereum is iOS, then obviously Solana is Android. There's competitors. And then, well, how does it actually accrue value? Well, just like when the apps are downloaded and used on your phone, it creates revenue for Apple and for Samsung. Well, just in Ethereum or in Solana, as the apps are downloaded and used and there's transaction fees, those transaction revenues accrue to the blockchain. So it's a very simple analogy. It works every time. And I'm begging those who are about to launch an ETF for Ethereum to please take this seriously and market this the right way, or it will fail miserably. So with that in mind, we'll end there. Happy days for crypto. Nice to see good 10, 20% rally across the board here, led by Ethereum, led by some Ethereum apps. Things like Lido, where you see staking yields probably go higher because these ETFs will not offer them. So it'll be more for the rest of us who are staking. But good to see overall market excitement here. Check back again next week. We'll have new topics to talk about. Come check out our blog on our website, ar.ca/blog, and you can read in depth some of the ideas we have to improve the digital asset market. And until then, my anticipation is that Ethereum is going to keep going higher here. There's still a pretty good short base here. There's a lot of underinvestment in the space. We'll see what happens on Thursday with the ETF filing. So that's it for this week. Again, thanks everybody. I'm Jeff Dorman, Chief Investment Officer at ARCA, and we'll see you next week. Take care.